Okay, so this video is all about the why. Why you shouldn't just have your work pension and the government pension and not worry about it. Because if you are not got a great pension or a government pension, then you're probably okay. But most people probably don't have a great pension. They might get the minimum from a company. So say 4% you put in yourself, 3% from the company and 1% from the government, so 8%. You might get a return of 7% in your default fund. And in that default fund, 60 or 70% is probably in equities, 30% is in bonds. Personally, I don't like bonds, so I don't if the bonds are lending money to the government for the government to do whatever they want with, well, we all know that the government spends more than they have, so they don't even know how to budget. So I don't want to personally invest in bonds. And then also, if you've been watching in the news recently, the government and the pension providers in the UK have been in negotiation, and the government have asked the pension providers to put 5% into the UK. Now, if they'd have said, oh, put 5% into the UK stocks, that might have been okay. But if you read the news articles, it's not actually in stocks, it's in other investments. So if they want 30% in bonds and then 5% in I don't know what, then I don't agree with that. I mean, if you're happy to leave your pension and not worry about it, that's fine. So personally, what you can do for a start is you can actually log into your pension, and you don't have to be in the default fund. I was put in the default fund in a recent pension I've been put into, and I just logged in and amended it to on average 17% a year. It's not guaranteed, but historically that's more the return you could expect. So that's an extra 10% there from logging in and quick. I think it took me about 5 minutes. So, and that means I'm not investing in bonds. I'm not investing into this new government change that they've signed up to, and it is in equities. Obviously, there is a risk there, but I don't think the bonds have actually returned much of a return anyway. So that's a risk I'm willing to take. Um, Everyone is different though, so you need to manage your own risk. So that's the pension. So I think 74% of the UK are going to fall short of having enough money in their pension by the time they retire. So there's another thing that doesn't work with the government, that they make the UK people pay in the percentages, and then they don't think about it and they don't look at it and they don't realise that when they get to retire, if they're not on a good pension, then it's too late. It's too late to worry about it when you get to retirement age. And then let's talk inflation quickly. So if inflation is say 2 or 3%, your 7% turns into 5%, which is even worse, isn't it? Now, the correlation of this is quite interesting. If I'm not going to go into too much detail, but if you are interested, look up on YouTube the Everything Code by Raoul Pal, or Pal is his last name. I can't pronounce how it is, but it's quite interesting on his theories. But don't go down the crypto rabbit hole. Just listen to his theories about, when the governments in the UK and America and the rest of the world, they print their money, well, then the stocks go up, but that causes inflation. So to the average person who's working, that means your buying power will go down by, I'm just going to say 2%. So your buying power each year goes down by 2%. Now, does your employer give you a 2% pay rise every year? I very much doubt that. If they do, good for you. You're in a good company. I think I've only had one inflation pay rise in the jobs I've been doing. So, and we all know what happened over, let's say, the C word, where everyone was sort of demanding, you know, pay rises because the inflation was so high there. But the thing is, it happens every year, not just in those scenarios. So, over the years, these 2% add up. So that means you're having less pay each year, but you don't feel it because it's hidden in the inflation. So the way to hedge against inflation, well, in my opinion, it's not financial advice, but in my opinion, you need to be earning more percentage a year to make up for the 2% loss, and you want some on top to make it worthwhile doing it. This is where I've got into ISA investments and the SIP investments. So this is the why. So for the normal people who don't invest, they go down 2% every year. And for the people who do invest, theirs goes up every year. It's about, the rich get richer and the poor get poorer. In my opinion, this is the basis for it. So this is the reason. I mean, if you are going to ask your boss for a 2% pay rise, it's probably easier just to invest and make it back that way, and cover yourself really. Plus, it's retirement planning. So, also going back to the work pensions, the fees, the average fee is 0.5% or 1%, which is, I think that's quite a lot really for what they actually do for you. It takes a lot off. Where you can see this portfolio of ETFs I mentioned in my last video, which you can go back and rewatch, is 0.21%. And I've chosen what I want to invest into. So I would rather choose than be put into the default fund on the. I do keep my work pension, don't get me wrong, because it is still worth having your work pension. So I'm not knocking work pensions, because you put in 4% and they put in 3 and the government put in 1. So you've doubled it before you've put it into the market for the 7%, which is actually 5% after inflation. So in my eyes, I'm getting 100% return before it goes in, and I'm getting 5% a year. I'm not going to knock that, and I do believe that. But I have changed what I actually invest into. Like I said, I get 17% a year return, so which is 10% more. So that's as much as I could do with my work pension, and I wouldn't not be in it. So I'm not discouraging you from being in there, but I do encourage you to log in and have a look. If you're not sure, leave it where it is. But if you look and you think, oh, I'd rather be invested in this, that, or the other, then have a look. They have different ones in there, so for you to choose, and you can always get, advice on further advice on that as well. Because, like I say, I'm not a financial advisor. It's just these are my opinions and what I'm doing about it. So, yeah. In my last video, I showed you these ETFs. There's 13 ETFs here that I'm investing into, and like I said, the fees are 0.21%. I can pay in a monthly fee. At the moment, I'm putting in £200 a month. I only opened this a week ago, so I'll just show you the returns quickly. It's only 1.14%, but that's in a week. Let's have a look. Just bear with me. Oh, there we go, 22nd of June to the 29th. So it's not a long term. And in my last video, I was showing you, I did have 4 ETFs in here. It's just the NASDAQ, the S&P 500, the All World, and the All World Dividend. So, but my last video is about diversifying more. So it's not just in America. So I'm just going to go through, and in case you haven't watched the other video, I'm just going to go through and just show you a couple to show you the returns that you could get compared to your pension, which I'm saying keep your pension, But if you want to top it up, then this is how I top it up. So let's look at the S&P 500. That's like the benchmark. And the reason, even though I'm in the UK, I'm looking at America, is America, they have better returns normally over the long term. Right. So here, now you might think, oh, that's a 5%. That's not great, but the market's been very up and down. Well, if you keep up with the news, you can probably know why it's been up and down. But over the long term, you can see it will beat you 7%. So the way to do it is to take the percentage and then divide it by the years, or alternatively, you can go down the bottom. There should be, there we go, the key investor information. That will, if you open that, that will give you the average yearly returns. And there's a little bit of dividends here as well. So that, over the long term, will bring you more percentage in than your pension. It is all in equities because it's stocks. You can see the stocks there, but it will be it will grow the wealth quicker than your officially 5% in the pension. So let's go back, and you can manage yourself what you pick into. Let me just show you another one. Let's just use the DAX, the German one. So the yearly return for the German DAX is 31.26. Well, that blows your 5% pension well out the water. And if you look over the max, 120% since 23rd of April 2020. So if you want to see me going through the whole portfolio, watch my last video, because I'm not going to go over all of that again. But these are the reasons why, if the UK population is going to fall short on their pension, this is my idea of a fix. So I've mentioned this in my other videos as well. There's two different ways to invest on Invest Engine. One is through the ISA, which you don't pay tax on the way out, which you will on your work pension. And there's also a SIP on here. Now, the SIP, 25% you can take out tax free, and the rest you'll get taxed like on income, like it was a job. So that's where the ISA is more flexible, and well, they're both good though. So the good part of the SIP is if you put £100 in, the government top it up by £25, which is brilliant. So imagine where was that tax when I was showing you? Just imagine you put your £100 in. Over the year, you get 31.26%, plus you'll get your £25 from the government. That's a pretty good return in a year. That definitely beats your 5%. But when you retire, like I said, you can take 25% lump sum tax free, but the rest you will get taxed on. Whereas if you put it in the ISA, you won't get any government top up, but you can take it out when you want. And the age is a difference as well, because on the SIP, I think it's 55 at the moment, but that's changing to 58 years old when you can take it out. Whereas on the ISA, you can take it out when you want. So to me, the ISA is just a genius thing. You can put up to 20 grand a year in there. I'm not saying you need to put 20 grand a year in there. You can invest in what you want, and you can take it out without being taxed, which is, I just think that's amazing, personally. So what I do, I'll just give you an overview of the whole of what I do. I do have my work pension, obviously, and I know I've just knocked them, but there is still good reasons to stay in them. Then I have my SIP. Then I have my ISA, and then I also own a few stocks on Trading 212, which I'll do in another video, but it's only I'd say I think I've got about a quarter in each. So I have a quarter in my work pension, a quarter in my SIP, which the government tops up by their percentage, and then I have a quarter in my ISA, and then I have a quarter in stocks. And they all return, well, not obviously not the work one, but the other three all do pretty good returns that beat the work pension. So this is my way of fixing the problem of one, inflation, and two, what you invested in, and three, getting a better return. So that's an overview. I will go in, like I say, I will go more in detail into the stock side. Um, some of you might not be interested in that way because ETFs, they're a lot safer. And as long as you've got an average return that you're happy with, then you should probably stick at that. What some of the other sites say is like you should have a core and satellite. So the core being mainly in ETFs, so say 80 or 90%, and then 10% in stocks if you want to have a play. But if you don't really know what you're doing, then you're better off just having them all in ETFs, where I'm a bit more risque and I have 25% in stocks. I think probably longer term I will reduce that and put more in the ETFs, but this is how it's set up at the moment. So there's an overview of how I, intend to fix things, but it's not financial advice. I'm not a financial advisor. I'm just showing you what I do with my investment and pension money. Any questions, just pop them below. Oh, I forgot to say, I'm not sponsored by Invest Engine at all, but if you do want to go and have a look on Invest Engine without even logging in or anything, you can go and on their site and there's a button up here called investments and you can just look. So if you want to look at the DAX, for example, you just go in and type, where is it? If you want to look at this one, for example, you just type in, click on the investment button, click on the ticker, well, type in the ticker symbol DAXX, or you can type it out there and it will give you the same information I've got. So you don't need to log in. If you do want to log in and start a portfolio, there's a discount link down below. You have to copy and paste it yet because I haven't set up the link function because I'm a new channel, so I haven't got around to doing that yet. I think you get a bonus. They'll put, I don't know. Well, the terms and conditions are on the site anyway. So if you want to do that, you can. You don't have to, but so I'm not sponsored by them. The reason I use Invest Engine is their platform fees are very reasonable compared to the other sites. So that's why, well, I showed you, didn't I? I showed you the fees here. There's it, 0.21%. So that's pretty good. That's better than the pension of 0.5 or 0.1%. Sorry, 1%. So that's why I use this one. You can't, on Invest Engine, you can't actually invest directly in stocks. It's all ETFs, which is probably a good thing, really. This is probably all you need. But Trading 212 do stocks and ETFs. But there are other problems with Trading 212 because if you invest in America, for example, you have the foreign exchange where with Invest Engine you don't have any of that. Or it is in there, but you just can't see it. So it's automatically behind the scenes. So yeah, I mean it's very clear on fees and they're low and you can choose what you want. So this is why I use Invest Engine. But like I said, I'm not sponsored by them at all. But if you want to go and have a look, have a look. If you don't, that's absolutely fine. I'm just showing you what I'm doing with my plan. So that's everything. Okay, thanks.